The fear index is rising fast and most investors have no idea where to hide when the market starts shaking like this. In this video, I'm going to show you 3 defensive stocks that could protect your portfolio, generate steady income, and quietly outperform while everything else is falling apart. These are businesses that dominate essential industries, control massive infrastructure, and generate predictable cash flow regardless of economic conditions. They are not dependent on hype cycles, they are not driven by speculation, and they are built to compound through uncertainty. And the best part is that when fear spikes, these kinds of companies often become even more attractive, because while everyone else is reacting emotionally, smart money starts positioning strategically. Let's get into the first stock. The first company is Verizon Communications, ticker symbol VZ. Now before we even talk about numbers, you need to understand why Verizon is one of the most strategically important businesses in the modern economy. This is not just a telecom company, this is infrastructure. Every single day, billions of connections happen across Verizon's network. Calls, messages, streaming, data usage, business operations, emergency services, all of it runs on systems like this. And here's the key insight. In a recession, people cut wants, not needs. They cancel subscriptions, they stop spending on luxury, they delay purchases. But they do not cancel their phone plan, they do not disconnect their internet, they do not step away from connectivity. That makes Verizon one of the most durable demand businesses in the market. And that durability is exactly what investors look for when the fear index starts rising. Now here is where things get interesting. According to the article, Verizon continues to generate strong and reliable cash flow, which is critical in a defensive environment. Because cash flow is what funds everything. It funds dividends, it funds debt payments, it funds infrastructure investments. And most importantly, it gives the company flexibility when markets become uncertain. Let me explain why that matters. When volatility spikes, investors stop chasing growth stories and start prioritizing safety. They want companies that can sustain themselves without needing perfect conditions. Verizon fits that perfectly. Now let's talk about one of the biggest reasons investors rotate into this stock during periods of fear: the dividend. Verizon offers a high dividend yield, and that becomes extremely attractive when markets are unstable. Because when stock prices become unpredictable, income becomes predictable, and predictable income reduces stress. Think about this from a psychological standpoint. If you own a stock that is dropping in price and it pays you nothing, your only focus is the loss. But if you own a stock that is paying you consistent income, your mindset shifts. You are still getting paid, you are still generating returns. You are not sitting there waiting and hoping. That changes behavior, and behavior is everything in investing. Most investors do not lose money because they pick bad companies. They lose money because they panic at the wrong time. Defensive stocks like Verizon reduce that panic. Now let's go deeper into the business itself. Verizon has spent years investing heavily into its network, especially with the rollout of 5G. And this is not just a marketing upgrade, this is long-term infrastructure that will power future industries. Autonomous technology, connected devices, industrial automation, smart infrastructure. All of these require fast, reliable networks, and Verizon is positioning itself as a core enabler of that future. So while the stock is defensive in the short term, it still has long-term relevance. That combination is powerful. Now let's address something most people bring up immediately: debt. Yes, Verizon carries significant debt. That is part of the telecom business model. Building infrastructure at this scale requires massive capital, but here is what separates strong companies from weak ones: the ability to service that debt. Verizon generates enough consistent cash flow to manage its obligations while still returning capital to shareholders. That is the key. Debt is not the problem. Unmanageable debt is the problem, and Verizon does not fall into that category. Now let's talk about another factor mentioned in the article: subscriber stability. Verizon's customer base is relatively sticky. People do not switch carriers frequently. There is friction involved. There are contracts, device ecosystems, bundled services. That creates retention. And retention creates predictable revenue. This is exactly what institutional investors want to see. Now let me give you a quick comparison scenario. Imagine 2 companies. One depends on advertising revenue that fluctuates based on economic conditions. The other depends on monthly subscriptions for essential services. Which one do you think performs better when fear rises? It is not even close. The subscription-based, essential service company wins almost every time, and that is exactly where Verizon sits. When markets enter uncertain phases, the winners are not always the fastest growers. They are the most stable operators. And stability is undervalued until it is needed. Now let's tie everything together. You have a company that provides essential infrastructure. You have recurring revenue from millions of subscribers. You have strong and consistent cash flow. You have a high dividend yield. And you have long-term positioning through 5G expansion. That is a defensive powerhouse. But here is the real question. Is Verizon the kind of stock that will double overnight? No. That is not the point. The point is protection. The point is income. The point is staying in the game while others are getting shaken out. Because long-term wealth is not built by chasing hype. It is built by surviving downturns and compounding over time. And Verizon helps you do exactly that. Now, before we move on to the second stock, I want you to think about this. If the market drops 20% from here, would you rather own speculative growth stocks or businesses that keep generating cash no matter what? Because that decision determines your outcome. Now, here is something important before we continue. If this resonates with you, you're exactly who this channel is for. People who are ready to stop losing money in the market and take their investment portfolio to the next level. Hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now, the second stock we are about to discuss operates in a completely different sector, but it might have one of the strongest moats in the entire market, and most investors completely underestimate it. The second stock is Coca-Cola, ticker symbol KO. Now, this is where a lot of investors make a critical mistake. They underestimate this business because it looks simple. They think it is just a beverage company, but Coca-Cola is not just selling drinks. It is selling habit, distribution, and global dominance. And those three things together create one of the most powerful defensive moats in the entire market. Let me explain. Coca-Cola products are consumed billions of times every single day across more than 200 countries. That level of scale is almost impossible to replicate. But the real advantage is not just the brand, it is the distribution system. Coca-Cola has built one of the most efficient global distribution networks in history. Its products are everywhere. Grocery stores, restaurants, vending machines, airports, convenience stores, stadiums. It does not matter where you go, Coca-Cola is already there. That creates something extremely powerful. Availability. And availability drives consumption. Now, here is the key insight you need to understand. In times of economic uncertainty, people do not suddenly stop consuming low-cost daily products. They may cut big expenses, they may delay large purchases, but they still spend on small habitual items, and beverages fall directly into that category. That is why Coca-Cola continues to perform even when the broader economy slows down. Now let's talk about something even more important: pricing power. Coca-Cola has the ability to raise prices without significantly impacting demand. That is one of the strongest advantages any company can have. Because when inflation rises, companies without pricing power get squeezed. Their costs go up, their margins shrink, their profitability declines. But Coca-Cola operates differently. It can pass those costs on to consumers, and consumers keep buying. That protects margins, that protects earnings, and that protects shareholder value. In a market driven by fear, the companies that win are not the ones that grow the fastest. They are the ones that maintain control. Control over pricing, control over demand, control over distribution. Coca-Cola checks all three. Now let's connect this back to the article. Coca-Cola continues to generate consistent earnings and strong cash flow, which supports its long-standing dividend. And this is critical, because just like Verizon, Coca-Cola is not just about stability, it is about income. Investors are not just looking for stocks that survive downturns, they are looking for stocks that continue to pay them while they wait. And Coca-Cola has built a reputation around returning capital to shareholders consistently. Now let's take this one level deeper. Global diversification. Coca-Cola generates revenue from multiple regions across the world. That means it is not dependent on a single economy. If one region slows down, another can offset that weakness. That diversification adds another layer of protection. And protection is exactly what you want when volatility rises. Coca-Cola is not static, it is evolving. The company continues to expand its product portfolio beyond traditional soft drinks. It is investing in different beverage categories. It is optimizing its operations. It is improving efficiency. This is not a slow company. It is a controlled company, and that distinction matters, because controlled growth is sustainable growth. Now let's talk about investor behavior again. When markets are calm, investors chase excitement. They want high growth. They want big upside. They want the next big thing. But when fear rises, that mindset changes completely. Investors start asking different questions. Is my capital safe? Is this business durable? Will this company still be performing if the economy slows down? Coca-Cola answers those questions. And that is why it consistently attracts capital during uncertain periods. Now think about this from a portfolio perspective. You now have Verizon, which provides essential connectivity and recurring subscription revenue. And you have Coca-Cola, which provides global consumer stability and pricing power. Two completely different industries, but both delivering the same outcome: consistency. And that is what makes a defensive portfolio work. Now here is something you need to understand clearly. Defensive does not mean boring. Defensive means reliable, and reliability is what allows you to stay invested during difficult periods. Because staying invested is how compounding actually works. Most investors do not fail because they lack knowledge. They fail because they cannot handle volatility. They sell at the worst possible time. They abandon good companies because of short-term fear. Defensive stocks reduce that behavior. They keep you grounded. They give you confidence. And that confidence allows you to make better decisions. Now, before we move on to the third and final stock, I want to share something with you. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, the third company we are about to break down is one of the most overlooked defensive businesses in the market, Waste Management, ticker symbol WM, and this might be the most underrated defensive business on this entire list, because it operates in an industry that most investors overlook completely, waste management. Now, at first glance, that does not sound exciting, but that is exactly why it works so well, because the best defensive businesses are not built on excitement, they are built on necessity. And waste collection is one of the most unavoidable services in the modern economy. Every household produces waste. Every business produces waste. Every city depends on waste management systems functioning efficiently every single day. That demand does not disappear during recessions. It does not slow down during market corrections. It continues. And that creates one of the most stable demand profiles you can find in any industry. Now, here is where the real advantage comes in. Barriers to entry. Waste management is not a business that new competitors can easily enter. It requires infrastructure. It requires logistics networks. It requires regulatory approvals. It requires long-term contracts. And all of that creates a protective moat around companies like WM. This is not an industry where disruption happens overnight. This is an industry where scale wins. And WM has scale. Now let's connect this back to the article. WM continues to deliver consistent revenue and solid operating performance, supported by long-term customer contracts and recurring service agreements. That means predictable cash flow. That means stability. And that means resilience when markets become volatile. Now here is something most investors miss. WM does not rely on consumer sentiment. It does not depend on discretionary spending. It does not fluctuate based on trends. It operates in a system where demand is constant, and constant demand is incredibly valuable during uncertain periods. Now let's talk about pricing power again, because just like the other companies we discussed, WM has the ability to adjust pricing over time. Through contracts, service structures, and operational efficiencies, the company can protect its margins even when costs rise. And that is critical, because in volatile markets, companies that cannot protect their margins tend to struggle. WM does not have that problem. While other companies are trying to figure out how to survive economic cycles, WM is operating in a business that continues regardless of the cycle. That is a completely different level of stability. Now let's talk about growth, because once again, defensive does not mean no growth. WM is investing in areas like recycling, sustainability, and renewable energy initiatives. These are long-term opportunities that expand the business beyond traditional waste collection. So you are not just getting a stable company. You are getting a company that is evolving with the future. Now let's step back and look at the full picture. You have Verizon providing essential communication infrastructure. You have Coca-Cola delivering global consumer demand and pricing power. And you have WM operating in an essential service industry with high barriers to entry. 3 different sectors, 3 different business models, but one shared characteristic: resilience. These are companies that continue to operate, generate cash, and return value to shareholders even when the market becomes uncertain. And that is exactly what defensive investing is about. Not avoiding volatility completely, but positioning yourself in a way that allows you to navigate it. Now here's the big question you need to ask yourself. If the market enters a prolonged period of fear, which of these businesses do you trust the most to hold up? Is it Verizon with its recurring subscription model and infrastructure backbone? Is it Coca-Cola with its global brand dominance and pricing power? Or is it WM with its essential service moat and consistent demand? Let me know in the comments, because your answer says a lot about your investing strategy. Now here is something important to understand before we close. Markets move in cycles. There are periods of growth, there are periods of fear, and there are periods of transition. Most investors only know how to operate in one type of market, and that is why they struggle. But experienced investors adapt. They shift their positioning. They focus on capital preservation when risk rises, and they lean into stability when uncertainty increases. That is how long-term wealth is built, not by guessing the next big winner, but by consistently making smart, disciplined decisions over time. The goal is not just to make money when markets are going up. The goal is to stay invested and continue compounding when markets are going down, because that is where most investors fall behind. And defensive stocks like these help you stay in the game. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.